Fixed mortgage rates surged last week as inflation reports came in higher than expected. And with the Federal Reserve in the US signaling that rates could remain higher for longer, that has many Canadians believing that at home, we could find ourselves in the same position. And as expectations that interest rates are going to come down look to be further and further away, the question is, what should you be doing if you're looking to get into the real estate market and need a new mortgage, or if you have a mortgage that's coming up for renewal? And that's what we're going to cover today, as well as the current interest rates. But before I get into it, my name's Nolan Matthias, and if you want Canadian real estate news, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. And if, like many, you thought, hey, I've already subscribed to Nolan's channel, why is that little button right below the screen not showing that I'm subscribed? That's because this is a brand new channel dedicated to Canadian real estate and mortgage news. So if you aren't already subscribed, make sure you hit that subscribe button. And if you're new to my content completely, go check out the other channel as well. I think you'll find some really cool financial and wealth building tools over there. Now, before I get into today's video, I do want to discuss something really important. And that is the fact that I'm retiring my very popular Rate Secrets course. That's right, the Rate Secrets course that over the last 2 years has sold thousands of copies and has helped thousands of people get a better rate on their mortgage is going to go away. Now, not forever, it's being revamped into Rate Secrets 2.0. The reason why is because today's environment is significantly different than the environment from 2 years ago. So that means there's newer, more relevant content that can be added. So rather than just adding it, I'm going to redo the whole thing and make it better. I'm also going to include a lot more content on how to renew your mortgage. But what that means for you right now is because I'm retiring Rate Secrets, you're going to get a really good deal on it. But if you buy the Rate Secrets course in the retirement sale, you're also going to get access to the future content, the brand new stuff. And here's the kicker. The course that I sold for anywhere from $97 to $247 over the last few years is going to be sold today for $27. But this is a one-time only offer. It will go away quickly, and you're only going to get one chance to buy it at that price. Plus, it's going to include all of the new material, all the old material, and I'll throw in a copy of my book, Mortgage Secrets, absolutely for free. So it's an absolute no-brainer, especially if you have a mortgage coming up for renewal, or if you're looking at getting a new mortgage. It gives you all the information on where to find the lowest interest rates, the best deals, and how to negotiate with a bank, a broker, and pretty much anybody else you'll interact with when you're getting a mortgage. Oh, and it tells you exactly how much room's available to be negotiated and all the things that you can get thrown in for free. So if you're in the market, this is the one time you will never get a better deal than this. $27. The information in it is worth tens of thousands of dollars in the amount of savings that you'll get just by being prepared. So go ahead, click the link in the description below or go to ratesecrets.ca and get your copy. Okay, so sales pitch over. But by the way, the reason I have that sales pitch is because I can't talk to everybody. And I really do believe that the information in that course is absolutely the best information that you can get on the topic. And I give it away for way less than it's actually worth. I mean, that's 20 years worth of experience. But that being said, let's talk about 20 years worth of experience and what we are seeing right now in the Canadian real estate market and in the Canadian mortgage market specifically, because we're seeing some pretty interesting stuff happen with bond rates. First, bond rates are at a 23-year high. So interest rates have gone up substantially. The reason why is multifold. There's the increased inflation numbers. There is a whole bunch of stuff happening in the US with respect to how long interest rates are going to have to remain high. There's the lack of unemployment that is happening that was expected from higher interest rates. And just a whole bunch of things globally that are affecting the bond yields. And even though we expected late 2023, early 2024 for interest rates to come down, the timing for the interest rates to come down seems to be getting pushed further and further back. And I want to start by showing you the Canada 5-year government bond yield, because this hit a pretty significant high last week when it hit 4.33% on September 27th. And that is the highest that it's been in, well, a pretty damn long time. We definitely haven't seen the Canadian bond this high since prior to 2006. And because fixed rate mortgages are priced off the Canada bond yield, that means that fixed rate mortgages have gone up quite substantially as well. In fact, they'll probably go up a little bit more this week and throughout the rest of October. Now, that being said, we did see some relief on Friday as bond yields came down just a little bit, but I think we found a new trend line at least for where these rates are going to end up, or at least where they're going to be for the next little while. And I'll get to what those 5-year fixed rates are in a second, but they're approaching 6%. Let's talk for a second about why we're seeing this upward pressure. So first, we saw Canadian inflation jump in August, and this led to a rise in October rate hike bets. So in other words, because we saw higher inflation, the market kind of indicated that they thought that we might see a rate hike in October. This is normal. And when they say market bets that interest rates are going to go up happened, well, that means that bond yields increase. So that's what we just saw. Now, the key thing you need to know about the Canadian inflation numbers is that 50% of the items in the Canadian inflation basket did go up in price by at least 5% in August. And the core inflation, the number, the indice that the Bank of Canada has indicated that they are watching most closely, increased by a full 1%. So this is going to apply upward pressure on interest rates. There's no doubt about that. But that being said, there's some other news that's come out that's probably going to create some pause for the Bank of Canada as well. The most notable is that Canada's economic growth missed expectations in September. Sorry, let me correct that, in August, and was only at 0.1%. Now, this is important because negative GDP growth, negative economic growth for 2 quarters is a recession. Where we're at is pretty much flat. We aren't negative yet. There's a chance, there's a likelihood that these numbers will get revised down over the coming months. But where we're at right now isn't technically a recession, but it sure feels like it. And the other thing that's coming up is job losses. We're seeing companies reduce hours, reduce number of employees, RBC probably being the most notable of those. And everything that we're seeing is indicating that we are starting to turn a corner, at least from an economic growth perspective. And when there's less economic growth, that means there's less money in the economy for people to spend and companies to spend, which usually starts to create a negative effect on inflation. So right now, the Bank of Canada is in this balancing act between the inflation numbers coming in slightly higher than expected and all of the negative things that seem to be starting to happen in the economy because of the higher interest rates. So then the question becomes, does the Bank of Canada act on the inflation data, or do they wait to see what's going to happen over the coming months? Now, the truth here is it's anybody's guess. They have indicated that they're going to pause, but if they seem like this might be something that could be getting out of control in the long run, there is a high likelihood that they could slam on the brakes and hit us with another interest rate hike to make sure that everything is stopped in its tracks. Now, certainly nobody hopes for that, and we are seeing people start to feel stressed. We're seeing MLS listings be at the highest rate that they've been in basically the last year, and a large part of that is due to the fact that people are trying to get out of the homes that they feel like they may not be able to pay for. And that's leading to some buying opportunities for Canadians as well. And there's lots of people still jumping into the real estate market in hopes of being able to buy a home and not find themselves in a position where they have to rent an extremely high-priced home, which, by the way, rental prices are going up in value significantly as well. So then the question becomes, what are the interest rates that those people are going to have to pay? Well, let's take a look. So as we always do, I'm going to start with the 5-year fixed full-featured rates. These are the mortgages that come with all the bells and whistles. They have full prepayment privileges, all the bank features. One key difference between these and the bank mortgages, though, they have a significantly lower penalty if interest rates go down. That's going to be really, really important if and when interest rates do go down, because what that means is if you have this type of full-featured 5-year fixed mortgage, there is a chance, potentially an opportunity, to refinance into a lower rate and pay the penalty. Now, the big thing about paying a penalty is you only do that if it makes sense. And I can tell you right now, if you're getting into a 5-year fixed mortgage with a big bank and interest rates do go down, the way their penalties are set up relative to non-bank lenders is to their benefit, and they basically make it impossible for you to be able to switch to a different lender and get a better rate. You basically lose all of your power, all your flexibility, and you're pretty much stuck. So let's take a look at the 5-year fixed full featured. These are non-bank rates. First is the insured rate. This is when you're putting less than 20% down. The current rate is 5.84%. Now, I put in the previous rates from a couple months ago here, just so you can see the difference between where rates are now compared to where they were in July. Then if you take a look at putting 20% down, these are the most risky mortgages for the banks. This is where they don't have the CMHC, the Genworth insurance, to the same extent, and where you have the least amount of equity and are most likely to walk away from a property, putting the banks at risk of having to foreclose and own it. If you have an insured mortgage, they just hand it off to the insurer and don't have to worry about it. So these are the mortgages for the banks that are the most risky, and therefore they're priced the highest. So 6.09% at 20% down. Then when you get to 25% and 30% down, you're looking at 5.99 and 5.94% respectively. Then when you get to greater than 35% down and under $1 million purchase price, you're looking at 5.84, which is pretty similar to the insured rate. This is because this is the point where banks expect that people are not going to walk away from a property and that the values aren't going to decline enough that it makes sense for somebody to walk away from the equity in their property. So the banks basically don't expect that there's going to be a 35% reduction in housing values anytime soon, and therefore they're willing to offer the best rates to these types of borrowers. Then, if you're looking at refinancing, if you're looking at a property that is greater than $1 million, if you're looking at a mortgage that is longer than 25 years, so a 30-year mortgage, these are mortgages that are uninsurable. The banks can't even get their own insurance on these, so they're priced significantly higher again at 6.59%. You can see there is a big jump in interest rates when you start to get into $1 million plus properties, uninsurable, refinances over $1 million, all of those things. And the reason why is because these are simply the most risky mortgages for the bank, and they just don't want them on their books right now. Now, moving into the 5-year variable mortgages, these are full featured. They're typically adjustable. That's the only type of variable rate mortgage that we sell. So they don't have fixed payments. They have the adjustable payments. That's the kind that doesn't get you in a whole bunch of trouble. There's a whole bunch of other videos we can make on that. But basically, these are, again, non-bank mortgages, the best of the best. The reason why the non-bank mortgages are the best of the best is because they can't skate on their marketing budgets and their reputations. They actually have to have better products, and therefore they do. So these are unchanged for the last couple of months, other than prime rate going up by 25 basis points to 7.2%. You can get an insured mortgage at prime minus 0.9. You can get 20% down at prime minus 0.55, 25% down at prime minus 0.55, 30% down at prime minus 0.75, and 35% down or more at prime minus 0.9. So in other words, 6.3%. Then those uninsurable refinances, 30-year amortizations, those are priced at prime minus 0.25, so basically 6.95%. Now, this is where it's getting interesting because at a variable rate of 6.3% versus a 5-year fixed rate of 5.84, we're still in that territory where the 5-year fixed seems to make more sense, especially if you've got a low penalty version. But that being said, the gap between fixed and variable rates is getting closer and closer again, which could start to indicate in the near future that it may start to make more sense to once again be choosing a variable rate mortgage, of course, with an adjustable payment. Now, I'm going to put up the 5-year discount rates here for you. These are the 5-year fixed discount rates. I'm not going to go into them one by one like I did on the full featured ones. The reason why is because these are generally not the type of mortgages that I expect most borrowers to get once they understand the difference. In fact, most of our clients, once they understand the difference between a full featured mortgage and a discount mortgage, end up not getting the discount mortgage. But this is the type of mortgage that if you Google lowest interest rate in Canada, this is the one that you'll find. And like everything else in life, you get what you pay for. They come with a catch. It depends on which mortgage it is, what type of catch that they come with. But if you're getting the absolute lowest rate in Canada at any given time, there's a high likelihood that you're giving something up. That could be something like the ability to refinance and switch to another lender. Doesn't matter how big the penalty is if you have the complete inability to do it because you've given up all your negotiating power completely and you don't have the ability to say to a lender, hey, I can get a lower rate over here. Can you do something for me? Because you've signed a contract that says, no, you can't leave, and that you're going to have to stick it out with them until the end of the term. Now, that's one scenario where it can be dangerous. Another scenario is if you can't refinance, you can't qualify with the lender that you're at, and you need to get money out, say for an operation or some other form of emergency. Well, these are the same types of mortgages that would prevent you from being able to do that. So we don't recommend these. And again, once people understand that they can't access their equity necessarily if they have this type of mortgage, they tend to steer clear. But if the client tells me, hey, that's what I want, I'm happy to go get it for them. Most of our clients, so like I said, once they understand the difference, don't want this type of mortgage. I'll rip through the 5-year variable discount mortgage rates for you. And if you want to take a look at these, just click the pause button. So that's the interest rate update for October. Lots going on in the market. Obviously, we're looking at higher and higher interest rates every single day in the US. Some mortgages are now being priced above 8%. I don't think we'll get there soon, but it is possible we will get there. So here's what's important. If you're getting a mortgage or you have a mortgage coming up for renewal in the next 6 months, make sure you get an application into somewhere that is going to put a rate hold in for you. We can do that at Mortgage 360. Just apply at the link in the description below, but make sure that you're covered. Make sure you're protected from rising interest rates. You may never have to use that interest rate hold, but it's definitely worth having just in case. And if your mortgage is coming up for renewal in the next 3 to 6 months, make sure that you're talking to a broker right away so that you can start planning for that renewal now. If you don't start doing it right now, there is a possibility that rates could go up and you could be paying significantly higher in 3 to 6 months when that mortgage does come up for renewal. So act now, make sure you're being proactive. And by the way, you need to also be aware that some banks have chosen not to renew all of their mortgages that are coming up for renewal. If you want to know more about that, make sure you watch this video right here.